Investors have been on the hunt for ways to play defense, as concerns over economic growth and President Donald Trump's tariff plans put Wall Street on edge. Against this backdrop, investors could consider rotating some assets into defensive stocks to protect their portfolios. These are a few sectors to look at in times of market uncertainty. Concerns about the economy are hurting the stock market this year, and tariff fears recently sent the S&P 500 and the Nasdaq into correction territory. Even the so-called Magnificent Seven tech stocks have now become the Lag 7 as they underperform the broader market. For investors looking to hedge some risk without cutting too much stock exposure, defensive stocks are a popular option. These are not to be confused with defense stocks, which include companies that produce things like weapons and fighter jets. Instead, when we say defensive stocks, we refer to companies that produce regular income through dividends and maintain relative price stability despite volatility in the market. On the flip side, some of them don't have much growth potential. As we can see, defensive corners of the market, such as consumer staples, utilities, and healthcare, are vastly outperforming the broader market this year. Let's look at each and see why. Consumer staples companies provide essential goods and services, the things your household needs every day regardless of the state of the economy, like groceries. These are companies like Costco, Walmart, and Coca-Cola, which has been holding up pretty well even during the market's recent sharp downturns. Utility companies provide electricity, water, and gas, things that you cannot scale back on easily. These include companies like PG&E, Vistra, and Duke Energy. Some of these companies took a big hit this year, especially after the new DeepSeek chatbot showed AI could be developed with less energy consumption than expected. But overall, the sector is holding up, and companies like Duke Energy are outperforming the market. Healthcare is a bit of a mixed bag, even though it's technically considered a defensive sector because healthcare is a basic need. Pharmaceutical companies that produce new drugs also have a growth aspect that can make them more volatile than utilities or consumer staples. These include companies like Pfizer, Eli Lilly, and CVS. Shares of CVS Health Corporation have jumped over 48% so far in 2025 after the drugstore chain and healthcare services company reported better than expected quarterly earnings last month. So, as we can see, each one of these sectors targets an essential need, but that's not the only reason why they could be a good protection for a portfolio during times of high volatility. Their valuations tend to be much lower than the broader S&P 500 and other mega-cap tech stocks. The forward price-to-earnings ratio for the utilities and healthcare sectors is around 17, while the S&P 500's forward PE ratio is at a level around 20, according to Dow Jones market data. Some of the defensive stocks are also dividend-paying companies, meaning that they distribute earnings, often quarterly, to their shareholders in the form of cash. These firms are often more financially stable and have predictable cash flows, offering a place for investors to hide while generating appealing passive income. Lower treasury yields are also making dividend-paying stocks more attractive. At the very end of the day, defensive stocks are not completely risk-free like treasuries or money market funds, but they will keep you invested while allowing you to sleep a little bit easier at night.